But returning to silver, silver has been priced like one of these base metals, and there's nothing in it at all in terms of premium for its monetary role. But I think that is also going to return because gold is very, very under-owned. It's a racing certainty that as members of the public begin to catch up with what's gone on in gold, they will, at the margin, prefer to buy silver rather than gold on the basis that gold has already gone up and silver, has been left behind. So what we're looking at, in answer to your question, is silver is definitely on a tear and it's going to go considerably higher. And it's been doing it since I wrote that article. And I see this continuing.
Alasdair Macleod, head of research at GoldMoney and a longtime monetary economist, has recently highlighted a growing divergence in the performance of gold and silver, with silver increasingly demonstrating strength beyond its traditional industrial classification. While both metals have held up impressively through the recent market turbulence, silver has begun to outpace gold on a relative basis, a move Macleod interprets as a signal of deeper structural shifts within the monetary system. Macroeconomic uncertainty, de-dollarization efforts, and heightened interest in physical precious metals amid geopolitical realignments further reinforce this trend. Macleod argues that silver's ascent is not merely technical. It reflects growing awareness of the metal's historical role as sound money and its growing scarcity within the global supply chain. From a long-term valuation perspective, Macleod has analyzed industrial metals relative to gold, which he considers a stable benchmark of purchasing power over centuries. His research reveals that base metals are currently priced at a roughly 77% discount to their average value in 1990 when priced in gold terms. This historical anomaly suggests a reversion to the mean is likely. Silver, which has long been priced predominantly as an industrial commodity, currently carries little to no premium for its monetary characteristics. However, as confidence in fiat currencies weakens and physical demand rises, particularly from emerging economies, this discount is likely to correct. In Macleod's view, this positions silver as significantly undervalued, with substantial upside potential as capital rotates from financialized paper assets into tangible stores of value. This underappreciation is especially evident in institutional portfolio allocations. According to Macleod, less than 2% of global portfolio assets are allocated to gold ETFs, and silver remains even further underrepresented. Regulatory limitations, particularly in Western financial systems, make direct ownership of physical metals challenging for most institutional investors, who instead rely on substitutes such as ETFs. Meanwhile, retail investors in Asia and parts of the global South have continued to accumulate physical bullion steadily. Macleod concludes that the current environment, marked by high inflation, weakening fiat credibility, and systemic uncertainty, is setting the stage for a substantial repricing of hard assets. In this landscape, silver may be the most asymmetric opportunity, offering both monetary optionality and industrial utility as the global financial system continues to evolve. Now, we present the clips from Alasdair's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Following this recent run-up, can you bring us through your thinking on that and where you came to as part of that analysis?
Yes. Obviously, there's always volatility in the prices of any commodity. But what I did was I thought I ought to have a look at metals prices in the context of the longer term, and particularly silver. Now, silver has been behaving as an industrial metal, if you like, a basket of base metal prices going all the way back to 1900. And if you price that in gold, that is quite revealing. Bearing in mind that over reasonable periods of time, and I'm talking about decades, centuries, millennia even, the purchasing power of gold is relatively constant. The reason for this is that gold is accepted everywhere as money, and unlike Bitcoin, the supply increases, and it increases at a rate which, while it can vary, is more or less in line with the global population. you have a stability, if you like, when you price anything in gold. And we certainly saw this up until the point where the Bretton Woods standard collapsed. The point is that if you take the prices at the beginning of the last century, so we're talking about over 127 years, you can see this stability in a basket of base metals priced in gold. But interestingly, recently, the value of these base metals priced in gold has actually declined quite significantly. And this year, it's standing at a roughly 77% discount to that 1990 level. Now, it always returns back to that level. Sometimes it'll go over, sometimes it'll undershoot, whatever. But what that indicates is that irrespective of what's happening to fiat currencies and their purchasing power, these base metals as a package, we can expect them over a period of time, we don't know how long, to increase roughly 3 to 4 times. Now, that is before you talk about the debasement effect of fiat currencies on metals prices. Now, this is very important. What it tells us in a nutshell is that base metals are more underpriced than they have been in the last 127 years, 25 years, sorry. This is really quite something. So this has significant implications. We're not just talking about base metals, but if we're looking at other commodities, you're going to get a similar sort of message. And therefore, the implications for consumer prices, let's say on a 5 to 10 year view, is that they're likely to go considerably higher. So the rate of inflation, if you like, even though the government suppresses the numbers, will increase. But returning to silver, silver has been priced like one of these base metals, and there's nothing in it at all in terms of premium for its monetary role. But I think that is also going to return because gold is very, very under-owned. It's a racing certainty that as members of the public begin to catch up with what's gone on in gold, they will, at the margin, prefer to buy silver rather than gold on the basis that gold has already gone up and silver, has been left behind. So what we're looking at, in answer to your question, is silver is definitely on a tear and it's going to go considerably higher. And it's been doing it since I wrote that article. And I see this continuing. As far as gold is concerned, it's just been consolidating sideways. It's extraordinary how it's just moved sideways for the last, 2-3 months, consolidating and really providing a platform for the next rise up. In technical terms, we have what's called a pennant. Some would call it a triangle. And that triangle consists usually of about 5 legs. You go down, up, down, up, down. Now, we're on the final down leg. And this actually coincides with option expiry for the August contract, which is on Monday. So I would expect to see gold drift off a little bit, but we're talking, 1-2% sort of thing. This is not meaningful in the scheme of things. The other thing I would throw in is that this underpricing of metals as a whole is now leading to indigestion, if you like, in the papers markets. If you look at the best performing commodities this year so far, platinum, palladium, copper, silver, gold. It is extraordinary. And this is reflecting just how undervalued metals as a whole, precious or otherwise, have become. So anyone who thinks that there is going to be a decent reaction in gold and they're going to be able to get into it and all the rest of it, I think they're going to miss it, I'm afraid. And that's the way it is. It's very under-owned. If you look at the other way of looking at this is this is gold, admittedly, but it's estimated that total portfolio assets around the world, global assets, are in the region of, I think the 2023 figure was $270 trillion. If you look just at the ETFs, that represents less than 0.2% of that. I'm talking about global ETFs. Now, the reason I would say ETFs is that in most of the world, in terms of portfolios, you have got investment regulation, and gold is not a regulated investment. So it's actually quite difficult for an investment manager roll gold, physical gold, into a portfolio because he's got to argue the toss with his compliance officer. And do you want to do that? No, you don't. So what you do is you buy a gold substitute. That is why I think that the gold substitute in the form of ETFs, which is a regulated investment, is a fair indication of the level of gold interest in portfolios. Now, obviously, there is an element of wealth, and a fairly large element of wealth, like say a larger element of wealth than ETFs, privately held as private wealth, not part of, if you like, the sort of regulated investment scene. So it's not recorded, if you like, in ETFs. But nonetheless, I mean, that's very concentrated in Asian hands. We know that. But when it comes to US, when it comes to UK, when it comes to EU, and when it comes to, our friends in Australia and Japan and so on and so forth, gold is very underowned. So if you get some sort of crisis and a flight into the dollar, here's what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. So this is why I feel the downside in gold is very limited. And of course, the other thing is, and this is desperately important, it's not so much the gold price has been rising, but the dollar has been falling. And so much so that we've even seen this in the trade-weighted index. So in short, there is a lot of catching up to do. And I think it's all part and parcel of the swan song, if you like, of fiat currencies.
Recent developments in global financial markets highlight growing concerns about the weakening US dollar. While the dollar index may fluctuate against other fiat currencies, its purchasing power continues to erode steadily when measured against real assets such as gold and silver. Alasdair Macleod points out that this apparent strength of the dollar is misleading. It is merely relative, as all fiat currencies are simultaneously losing value due to rising national debts, inflationary pressures, and an expanding money supply. The traditional belief that money in the bank is secure is being challenged as investors and savers increasingly seek to protect their wealth by moving funds out of unstable fiat systems and into tangible assets. According to Macleod, this shift represents a critical turning point where confidence in fiat currencies is deteriorating, compelling more individuals and institutions to reconsider their portfolios in favor of physical metals. In this environment, silver has emerged as a particularly attractive asset, benefiting from both its role as an industrial metal and its historical monetary significance. Unlike gold, which has experienced a period of consolidation, silver has shown significant momentum, reflecting a growing recognition that it remains undervalued relative to both its industrial demand and gold prices. Macleod emphasizes that the gold-to-silver ratio remains unusually high, underscoring silver's potential for considerable appreciation as investors seek alternatives to fiat money amid increasing currency debasement. This dual characteristic makes silver a compelling store of value and a strategic hedge against systemic risks, positioning it as a critical component for preserving wealth in today's uncertain economic landscape.
What you say is perfectly natural because you account in dollars and you pay your taxes in dollars. And so from the point of view of whether you're up or down, your risk-free position basically is cash dollars. But this is all an illusion because what you're looking at is credit. It is a credit risk which depends on your faith in the Fed. And because it's a federal dollar, it's the Fed's dollar. And in turn, of course, the faith that you might have in the Fed is going to depend very much on the faith in the US government. Now, the reason that foreigners probably recognize this first and domestic users of the dollar recognize it last is obvious because foreigners, from their point of view, their risk-free position is their own currency. So, let's say, a Brit investing in dollars or whatever, he sees risk because he is accounting in sterling. He pays taxes in sterling. He makes his profits in sterling. So you can see that foreigners are a lot more sensitive to what's going on, let's say, in a foreign currency than domestic users. Domestic users, they don't actually understand, the difference between money and credit, gold being money and the rest being credit. And the second thing is that they assume that all the price changes they see prices rising. They think it's not the dollar going down in terms of its purchasing power. They think it's items rising, for whatever reason. I mean, they call it inflation. Actually, inflation is a description of what happens to the quantity of credit. It's a complete misnomer when you're talking about what's actually happening to prices. Prices are rising, they're not inflating. Now, that's a different thing. The only way to look at it really is to understand that the dollar's value in transactions is not a constant. It is something that is moving all the time. And for a long time, it's been moving downwards. I mean, if you look at it in terms of gold, I mean, going back to 1933, you had $20.67 to an ounce of gold. Now you've got $3,400 to an ounce of gold. Well, what does that tell you? Does it tell you gold's gone up? No, it tells you the dollar's gone down. And we've had a constant stream of crises ever since 1933. First of all, there was the devaluation of the dollar. I mean, this is an interesting one because people will say, well, they rose the price of gold from $20.67 up to $35. Really? Actually, what they did was they devalued the dollar by 40%. And then, of course, you had the Bretton Woods thing in 1971, driven off Bretton Woods. Nixon said he suspended it, to stop foreigners speculating and all this sort of garbage that politicians talk about when it comes to what they think is money. They were driven off it because basically what was happening is that as long as they fixed the dollar at 35 to the ounce, foreigners were just, saying, well, here, you can have my dollars. I want the gold at that price. Thank you very much. And from about 1947, 8, round about then, America had 22,000 tons of gold in its reserves. And by the time Bretton Woods was suspended, that went down to 9,000 tons. They were clearly running out. And, at the time, they were having to sort of sweep around, see what they could find left in the Fort Knox vaults. And, a lot of it probably wasn't actually deliverable into markets. So that's what happened. We've got, for example, in the UK, as late as 1935, the gold sovereign was worth £1. Today, one sovereign is worth £600. Is it because the sovereign's gone up? No, it's because the pound is rubbish. It's gone down. So this is the message which everybody's got to understand. And this is why the last people who understand it are the people who sort of wake up to the fact that it's not prices going up, but it's the currency going down. And when people actually do understand that, when the general population understands that, the currency is doomed. We are not there yet, but we will go there. Just look at it from 2 points of view. I mean, in the G7 nations, they've all got high debt to GDPs, and when interest rates rise, and they are rising, do not believe that they're falling. If they fall, they're being suppressed, and that kills the currency. You can see that which way this is going for all these currencies. It's almost like a race to the bottom, if you like. The thing about the dollar is that the dollar is the most important fiat currency. And there will come a time when the Dixie starts rallying for the very simple reason that everything else is falling faster than the dollar. That I think is going to happen. My own view on sterling is that sterling is it's in a huge, great mess. Or more accurately, I'd say that government finances are in a horrendous mess. And so far, this has been ignored because where is the attention? The attention has been on, the wonderful President Trump and all his running around and upsetting things and all the rest of it, and trade and big, beautiful bills and so on. So, in terms of bad news, he's been stealing the limelight. That's going to shift. It will shift at some stage. I don't know when. I don't think it'll be terribly long. So the idea that the Dixie is going to go down and down and down and down is actually not the way to look at it. The dollar is going down and down and down against gold, not Dixie. I mean, I can see the Dixie falling to 90 from the current, 97.5, 8, something like that. That wouldn't surprise me at all. But in the grand scheme of things, that's not all that important. So, some people argue that President Trump wants to see the dollar lower. I think he's talked about it. He certainly wants interest rates lower. And I think his attack on Jay Powell is actually very misguided. I think that's a very stupid thing to do. It's completely nonsensical. As indeed, from a foreign point of view, most of his trade policies are completely nonsensical as well. All other currencies are basically in the same boat. And we can see the yields on longer JGBs are on the rise again. I think we're hitting new highs for, 20-odd years or something on the yield on the 10-year JGB. And if you go longer, apparently there's absolutely no market in the 30 and 40-year-olds. Maturities. What's going to trigger a new phase in this crisis? We just don't know. With everybody in the same sort of mess, to greater or lesser degrees, it could come from anywhere. And which makes me think that anyone who sort of thinks, oh well, we'll muddle along a bit longer, I think is holding a hostage to fortune. I really do.
Looking ahead, silver is expected to experience a strong and sustained rise in value, as its dual role as both an industrial metal and a precious store of value gains renewed recognition. With increasing demand from sectors such as electronics, renewable energy, and healthcare, combined with growing investor interest in tangible assets to protect against inflation and currency instability, silver's price is poised to rise significantly. Additionally, ongoing monetary easing and weakening fiat currencies worldwide will likely drive more investors and institutions toward silver, pushing its price upward and narrowing the historical gap with gold. This unique combination of factors positions silver to outperform many commodities in the coming years, making it a crucial asset for those seeking both growth and security amid global economic uncertainties. With these dynamics in mind, how do you anticipate silver prices will move in the coming months? Do you expect a steady climb or a sharp surge? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.